Hello, hello. Amanda here from UTDo, my business UTDo, making accounting, taxes, business requirements simple so that you can bring your better services to the world and enjoy working for yourself. You can find me at amandarussell.mba. And in this video, I'm going to talk about, at tax time, you may recall often hearing that you can contribute to an IRA in order to save taxes. And this is a tactic that a lot of tax professionals will advertise because it can save you substantial tax dollars. But I'm going to talk a little bit about this situation and my recommendation in regards to saving tax dollars with this. This is a question one of my clients submitted to me, and you're welcome to submit questions to contact us at utdu.info. And I would love to hear from you, and I'll answer your question in a live stream and tag you in it on YouTube or send it to you. Tag you in it on Facebook or send it to you on YouTube. All right, and I'm actually going on a trip today, so I'm recording this while driving. But so oftentimes when you're filing your taxes, you'll hear, they'll say, you know, if you set up an IRA, you can contribute, an IRA retirement plan. Now, when you're self-employed and you set up your retirement plans, it is a little, they're called SEP IRAs, and generally SEP are simple plans, and they're just specific to your business. And there are benefits to doing the business instead of just a personal plan, because the deduction, the limitations are higher. So you can earn more, contribute more. So that's why you would want to form those, as well as contribute on behalf of your employees. They're structured to facilitate that. So that's the first thing, just to give a little bit of general information. Now, when it comes to retirement plans, there are two types, IRA and Roth. In general, the IRA has this tax deduction. And that's what everyone's familiar with. But the Roth is the newer one, and there's no tax deduction. However, it makes everything easier, and I highly recommend doing the Roth and not worrying about the IRA tax deduction. With the IRAs, you get to contribute before tax to your retirement plan, but then you have to keep track each year of your contributions that were before tax, if you were limited, ones after tax. And then when you withdraw funds later on, then you're taxed on a portion of your withdrawal based on your basis, what was contributed before tax and after tax. Sound confusing? It is, and it requires you to keep very detailed records that oftentimes people don't have. And so calculating this sort of thing can be very cumbersome. So in general, although they'll say you can save $1,000 in taxes, but you got to spend $4,000. So I know that there is this mentality around saving taxes. You know, we've become a society that's really consumed with saving taxes instead of viewing taxes as our contribution to the streets and the system that we use, especially our businesses, because we have it easier here in the US than anywhere else in the world to start a business. So I think really shifting that mindset that taxes are not necessarily this thing that we must avoid at all costs, because then we can end up like with write-offs. You know, you get to deduct any costs you spend on your business, but you're spending money. So it's not like you're just getting free money. You know, you're spending money on stuff to get that write-off. So this is a lot of the stuff I talk about. I guess I've got a bad stream status. Well, I hope that answered everyone's question. I recommend doing the Roth over the IRA, because when you withdraw funds from your Roth, there's no taxes. So you don't get a deduction when you contribute to the Roth. However, when you withdraw, your interest that was earned on the plan isn't taxed. With the IRA, it is, because you never paid tax on that money. A percentage can be based on that whole basis I was talking about. But so the Roth is much simpler. You don't need to keep detailed records. You can contribute to the Roth and you can withdraw, and it's not taxable. It's easier. So in general, I recommend doing a Roth, okay? First of all, over the IRA, and not taking the IRA deduction to save some tax dollars, because chances are you're spending more money to put into the retirement plan than you're getting by far as a tax reduction. So it's going to cost you more money. Now, I understand that the retirement plan is an asset to you, but if you're struggling to have the funds, then it doesn't make sense to make that bill even higher. So by bill even higher, I mean having to contribute. So now what if you took an IRA because they tell you you can take it and then you just have to contribute by the extension due date, September 15th or October 15th? So what happens if you said you were going to do that and then stuff happened and you weren't able to contribute? Well, what I would recommend at that point is filing an amended tax return and removing the deduction. And I recommend using, if you do it yourself, Free Tax USA. That's one adjustment. It's a deduction for AGI, and they are super cheap, like $9.99. And you can email them and ask them questions, and they can help you do it. Now, of course, you can hire someone to do an amended return, and it should be a very easy thing for them to give you a cost on because you know exactly what the work is. I took an IRA deduction and I haven't been able to fund the IRA, so I want to amend my return and remove that deduction. You know, that's very straightforward, so they should be able to tell you exactly what they'll charge for that. But generally, I know I had a bad stream coming through when I was mentioning that I don't recommend taking the IRA for taxes. I recommend doing a Roth because it's much simpler and nothing is taxed when you withdraw from the Roth later on. You don't get a deduction now, but you also don't have all sorts of records to keep track of every year to then figure out what's taxable when you withdraw. So the Roth simplifies things immensely, and it ends up being, you know, you pay the taxes now while you know your situation, and that way later on when you're taking these withdrawals, there's just no stress. There's no figuring it out, what's taxable, what's not. It's a Roth, nothing's taxable. So go with the Roth, don't take the IRA deduction. You can always set up installment payment plans with the IRS, and you can check out, I have a freebie training for estimated taxes. The free part of the training is all about your business taxes when you're self-employed. And that includes if you formed an LLC and you're the only owner of your business. Now, I have a training that goes through 4 steps for you to follow all of your business tax requirements. My goal was to super simplify this because people are always struggling and confused and just kind of avoid and dread this stuff. So my goal was to make this simple so that you can feel like you're on top of your business side of your business. And that can give a lot of confidence. And that you really know your numbers. So the second half of that freebie training is an estimated tax e-course, which is step-by-step a spreadsheet I put together with step-by-step videos to walk you through updating that so that each quarter you run your business tax calculation and you figure out where you're at for taxes, what amount you need to pay to avoid a penalty, and what amount you need to pay to not owe any taxes at the end of the year. And so this training, the goal is to help you have no fines and penalties and to have no stress or payment due surprises come April 15th every year. And instead, you can be focused on planning the growth in your business that's coming for that following year. All right, thank you so much for watching, and I hope to see you in my free business tax calculator training where you learn 4 steps to follow all of your business tax requirements. All right, thank you so much, and I look forward to seeing you again. Remember, email any questions you have to contact us at utdu.info. All right, I look forward to hearing from you. Have a beautiful day.